So you found the house, the one with the better neighborhood, better schools, more space for your dog, and yet somehow it didn't have a price that made you laugh at it out loud. It's a miracle. There's just one problem. You already own a house and every lender you've called read you the same script in the same flat voice. Sell yours first and then we'll talk. Cool, thanks. That's very helpful. Did you also figure that out by yourself in the car on the way over? That advice is wrong. It might actually literally cost you the house you actually want. And in the next 12 minutes, I'm going to show you the 4 real ways move-up buyers are buying their next house before selling their current one. Which one fits which situation, what it actually costs, and the move most lenders will never mention because it pays me literally the same as taking grandma to find the remote. I'm Matt Wilson, a mortgage guy, and I close loans every week for people exactly like you, and I make mortgages not so. I'm tired of watching homeowners sitting on 6 figures of equity get told just sell first by a guy whose entire job today is just forwarding emails. Hang with me for a second. By the end of this, you'll know exactly what to do. Here's what's actually going on out there. Sellers don't want contingent offers. A contingent offer is when you walk up and say, I'll buy your house, but only if mine sells first. And also, only if the Browns win the Super Bowl. Sellers see those and immediately go check on the cash offer in the other pocket. So if you list your house first and start hunting, congratulations. You now have 30 to 45 days to find your dream home, win a bidding war, and close. That's not a strategy, it's a hostage situation with a Zillow login. And if you sell first and don't find anything, now you're renting, you're paying movers twice, or doing like I did and had to live with my in-laws for a few weeks. Your stuff is in 3 different storage units and the house you wanted actually just went pending by a guy named Brad. There's a better way, 4 of them. Let's go. Option 1. The bridge loan. A bridge loan is a short-term loan that's usually 6 to 12 months, and it uses the equity in your current home to fund the down payment on the new one. You close on the new house, move in, and then sell the old one. You pay off the bridge after you sell it. This is a great fit if you've got at least 20% equity in your current home and you got solid income and you can hold both payments possibly without doing anything dramatic. But I will say my company has one where you don't have to hold both payments at the same time. The cool thing is this prevents you from having to dig into your 401k for the down payment on the next house. Here's the thing, the real cost of these is that it'll be about 2% higher than a normal mortgage and you'll pay about 2% extra in origination fees. So yeah, you do have to trade off with a chunkier interest rate that sounds expensive until you remember the alternatives, not getting the house that you've been showing your spouse every night for the last 3 weeks. Here's when you don't want to use it. If you've got tight income, equity under 20%, or you're currently priced like you're trying to retire off of it, bridge loans are not going to fix it. Unfortunately, they can't help with delusional pricing. Here's when not to use it. If you've got tight income, your equity is under 20% on the home you're departing, or your current house is priced like you're trying to retire off of it, bridge loans aren't going to fix that. Option 2, a HELOC, otherwise known as a home equity line of credit. What you would do is open the HELOC on your current home before you list it. That part's very important because once your house hits the market, most banks slam the door shut on a new HELOC faster than you can slam yours when the doorbell rings at dinner. So I get it open first. Then you'll take the equity from the HELOC for your down payment. Close on the new place, move, and list the old one. When it sells, the HELOC gets paid off at closing. It's clean. HELOCs will usually come out cheaper than a bridge loan. They do have a variable rate, but for the length of time you're going to be holding the HELOC, it typically won't matter. A lot of them have no closing costs, which would be great for once. When this works, if you're planning at least 4 to 6 weeks in advance before you start listing your house and making offers, you've got good credit, you've got the discipline to only pull what you need for this and not accidentally buy a new Malibu boat. When you don't want to use it. If you're on a time crunch or you'll lose sleep over a variable rate moving on you during the next 3 months while you're carrying a balance, probably not the program for you. Option 3 are buy before you sell programs. These are programs that are designed to allow you to purchase the next house, sometimes in cash, before you've even put the last house on the market. My company's got a program called NAF Cash that you can just imagine your rich uncle goes and strokes a check, and then you buy it back from us after your home sells that you're departing. The great thing with these is it gives you the option to walk in with a non-contingent offer on the new house. You can literally write a cash offer and choose whatever inspections or whatever you want it to be. It's going to be the most competitive thing that you could possibly put down on that other house. Upsides. In this situation, you're going to make a clean non-contingent offer and sellers will fall in love with you. You'll go toe-to-toe with cash buyers and you won't flinch. Here's the downside. There's usually a fee, somewhere between 1.5% to 3.5% of the home value. And there's typically some sort of timeline for selling your previous home, or they're going to purchase the previous home for a discounted price. You're paying for convenience here. It's just like Uber Eats. You could get it cheaper yourself, but you want it to come to you. Here's what it works. If it's a super hot seller's market and every listing has 10 offers, the only ones really winning are non-contingent cash offers. If you'd rather do that and pay the fee than lose out on getting a new house altogether, this is the best fit. You don't want to use it if you have time and equity and you can self-fund with a bridge or HELOC. You need to run the math first, or we can run the math first to make sure which situation is going to be the best fit for you. Option 4. This is the one that nobody talks about, the recast. Here's the play. You buy the new house with a regular mortgage. You put down whatever you've got. 5, 10, 15%, whatever's clean. You move in and then you sell the old house. Once you sell it, take that equity, drop it on the new loan as a principal reduction, and then ask us to recast the loan. A recast is not a refinance. You're not paying closing costs again. We're not changing your interest rate. You're just dropping a fat chunk of change on the principal, and the loan will go down for us to recalculate your monthly payment based on the lower balance, just like you did it from the jump. Same rate, same term, just a lower payment. Most lenders are going to charge $250 to $500 to do this. That's it. It's less than a decent date night. This is the cleanest, cheapest play when it fits. This one works whenever your income alone qualifies for a new house at the same time as your old, and most of your cash isn't trapped in the previous home. And you can stomach having multiple payments for a couple of months until the old place sells. You can't use this if you can't qualify for both homes without leaning on the old one's equity or losing out on the debt to income ratio. Unfortunately, math doesn't care about your feelings. You also can't use this if your new home is going to require you to get like an FHA or a VA loan, because those don't allow you to actually recast. So which one of these fits your situation? Strong income, over 20% equity? Then a HELOC's probably the first cheapest path. The HELOC won't get done in time? Bridge loan's the option. If every house in your market has 10 offers and the only non-contingent ones are winning, look at NAFCash. We need to run the numbers before you sign anything. If your income qualifies you for the new house without doing any of the other programs, just recast after closing. It's usually the cleanest move. But honestly, the right answer depends on your equity, your income, your timeline, and your market, and what programs your lender actually has. Which is to say, it depends on whether or not your lender knows how to do more than two things. The biggest mistake that I see move-up buyers make is that they call their bank or some giant national mortgage company and they hear sell first. And then they believe it, like it came down with lightning and stone tablets from a mountain somewhere. Look, the big lenders aren't evil, they're just lazy. They don't make more money structuring a creative deal than they do whenever they do a vanilla one, so why would they bother? You're asking a guy who clocks out at 4:59 p.m. to think outside the box at 4:47. Probably not happening. That's not me. This is the entire thing that I do. If you have equity and income, there's almost always a way. Quick recap, there's 4 options. The bridge loan, the HELOC, buy before you sell, or just recast after closing. The sell first advice is broken into this market and you don't have to allow it. Real talk, if you're the kind of homeowner who's actually built something, you've worked hard, you've stacked equity, and you're ready to level up the house, you should not be losing the place that you want because your lender doesn't like opening a second tab in Chrome. Book a mortgage cheat code call with me. There's a link in the description. It's 20 minutes. We'll look at your numbers on your timeline and your market. I'll tell you exactly which one of these 4 moves fits. And if none of them do, I'll share that too. Yeah, even though I'm a mortgage guy. Wow. The buyers who win in this market are the ones who already know their options before they fall in love with the house. Be that buyer. I'll see you on the call.